All right, stock started off the morning, not surprisingly, to the upside, considering the debt ceiling resolution that was the deal that was put together over the weekend. It still has to get passed, and I think that's some wariness over its ability to be passed is built in. But I think there's also a little bit of a sell the news built into today's decline, especially considering the parabolic run that the Qs have been on lately. So we're going to continue to break down that move and see whether or not, again, all the eyes are going to be on whether the Qs can drag everything else up with it, whether everything's going to drag the Qs down. And so that's going to be the tug of war. So we're going to break that down today and see what's going on and how it performed. We're also going to take a look at, from the asset class standpoint, what drove today. It was a kind of a interesting risk on, risk off move, but not everything in those categories participated. So we'll break that down. And then, of course, a very not surprising sector rotation today that's continuing the same pattern that we've seen. That's pretty darn telling for us. We'll talk about that. And we took advantage of the weakness in some of these areas with our trade idea, with the bearish trade. And that's not as bearish as you think. So let's go ahead and get started. Today is Tuesday, May the 30th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel. This icon here or the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today down there. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. If you're following us here on our blog, check out some of these other things over here on the right, including, like I said, the Market Outlook live video I do. When I do these Market Outlooks, I always do a live video at 3:30 Eastern Time with the trade idea that we put on before the market closes. That's where I do that there. Come down to the bottom, click this heart. It opens up a new tab. I hit that like button. Same thing, click this thumbs up icon. It takes you to this tab. Hit that like button there. Again, that helps us get our content out to all of our followers. The more you do that, so we always ask you for it. Our goal is always to get above 100 likes on Twitter. So thank you everybody who like these day in and day out, and those who don't. Let's see if we can get up above 100 this time. You can do right now with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator here. You can see we finished the day flat, exactly flat. We finished Friday at 42.05.45. Today we finished at 42.05.52. So we were up a whopping 0.07% today. Not surprising, the momentum line's down as we filled in the gap. We opened up on the debt ceiling news, resolution news, and filled in the gap throughout the rest of the day. Came off the lows at the end of the day, so that's a good sign. But it didn't, again, the momentum line got in the bullish territory. It already is in bearish territory down in the pink shading there. So that means that the near-term line is unlikely, not impossible, because you can see it can go up there without the near-term line. It's done it a couple times here. But generally speaking, it's not common for the near-term line to go, especially up to strong levels, without the momentum line getting there first. One of the main reasons it did over here is because you had these gaps. You had a couple, like 3 gaps in a row there that really pushed us up to the upside. Not the case right now, right? We actually have filled in the gap that we had today. The intermediate line, you can see, is actually pointed slightly lower. That's why we have the pink shading up here. When it's pointed higher, you have the green shading. Dark green because you're above 50. Light pink because you're still above 50. It would be dark pink when you get below 50. Down there. So you do have light pink shading. It is still slightly below its market sentiment line too. So keep that in mind. When you're not in the reversal zone, anytime you get a crossover like that, it's either bullish or bearish. It's bullish on the near-term line crossing above the intermediate line, but then still bearish with the intermediate line down below market sentiment. And considering the momentum line's already down, I would expect the near-term line to follow suit here sooner rather than later. Maybe not tomorrow, but within the week, right? Again, unless we continue to really gap up and stay really bullish like we did over here. But here we were just starting this intermediate run. And of course, we've been on an intermediate run now, a very mature intermediate run for 2 months, pretty much through the entire months of April and May. Let's take a look at the NASDAQ 100, which is really driving things. You can see how parabolic it's gotten, up 7% above its moving average. Not the highest. The highest was was 12% in February there, and with the cluster, we did get a cluster here earlier. But the intermediate line, the momentum line did drop, just like it did on the Dow, down to the bearish territory. The near-term line still bullish. The intermediate line still bullish. Market sentiment line still bullish. So you got a cluster, just not the right cluster, right? Generally, when you get the momentum line up there with those three, well, on the day before, it was the momentum line, not the near-term line. The next day was the near-term line, not the momentum line. And that's how it is again today as we are approaching this 23% retracement of the post-COVID rally. Remember, the Dow has been above this since last year. If you look at the Dow has actually been above its 23% retracement line since the end of the year. Since last October, has been above it pretty much the entire time. The S&P 500 has not been, though it did get close in February, there on that February 2nd peak, and has been kind of close for a while now, and finally there. Not the case for the NASDAQ. The NASDAQ at that February peak wasn't anywhere near the 23% retracement, has not been anywhere near any of this period either, and now just has gotten to it with the parabolic move. So the NASDAQ had been lagging so far behind these other averages, and now it's starting to catch up a little bit. You saw the Dow Jones Industrial Average. Its intermediate posture is actually still strongly bearish. So the intermediate line's in the lower reversal zone, not just in bearish territory, but still in the lower reversal zone. Again, the momentum line dipping down already, with the near-term line most likely unable to get going too far, as the Dow is, dark pink shading and a red line is showing a bearish market forecast pattern. Same thing with your Russell 2000. It's kind of flirting with a bearish pattern, the intermediate line falling out of bullish territory without peaking in the reversal zone, which is a very bearish intermediate peak. I mean, this was an intermediate run. It got into bullish territory, but considering it did not get in the reversal zone, is very bearish, right? And unlike all these other intermediate runs where it did get in the reversal zone, this would be the first one where it didn't. Now, it's not over because it's got to get in the bearish territory to officially go from bullish to bearish, but it's not looking good. From that perspective, of course, momentum line didn't even get out of bearish territory hardly in the so it's very unlikely the near-term line is going to be able to stay very bullish at all. So more likely we're going to continue this decline down below that falling moving average, which once you get below it will be red again. You're just 0.25% still above it. But that's how we're starting off the short week. Remember, we only have 4 trading sessions here this week. Looking at the weekly chart, of course, we are getting a strong weekly pattern here so far. Again, only one day, but a strong. We did get a higher close last week. We're getting an easily higher close this week. Again, that's mainly a function of the NASDAQ, as parabolic as it's gotten. Look how big its candles are. Very, very large weekly candles. Obviously, that's not the case for the S&P. The S&P's candles are not large at all relative to other bullish moves it's had, so very weak from that perspective. The Dow Jones Industrial Average actually has negative candles, right? It has bearish candles still. We got a lower close last week. It's still a lower close this week. It's a higher low, but it's still a lower close this week too. Again, only one day into it. And we're closing, as of right now, we're closing below, I already have closed below the 10-week, and we did that 2 weeks ago with the Hakinyashi close. 3 weeks ago with the regular close with this red arrow. Now we have the Hakinyashi close below the 200-week of the 50-week, 40-week, sorry, which is the proxy for the 200-day, the 40-week exponential moving average. So it kind of goes to show just how bearish the Dow is. The Russell 2000, of course, has been below the 200-week for a while, and the 50-week for that matter. Has been trying to get above the 10-week and is not able to do that. So it's kind of getting all these transition candles. Since these bearish candles here, we've had nothing but transition candles. So it's not really trending in either direction, but still hovering at the low end of this range that we had dropped down to during that regional banking crisis that we had. Looking at the 3 green arrow charts, you can see 3 green arrows now for the S&P 500 again. Though we did get a red arrow on the stochastics today, so you only had one day there. The NASDAQ, of course, is very far away from getting a red arrow yet. Your closest would be the stochastics, more than likely. Your Russell 2000 has only one green arrow, or two green arrows. Looks like the MACD is barely green. Stochastic is falling. Your Dow Jones has three red arrows. So your MACD is still red, you're still below the moving average, and your stochastics is still red. So three red arrows on the Dow with three green arrows this entire time on the Qs. Kind of goes to show the big divergence that we're seeing there. So rare. It's so rare for that. I mean, again, you look at this correlation here. Oops. Go down to the correlation between, let's go the diamonds, and then we will open this up and compare the diamonds to the Qs. Put the Qs on there, and then we'll put the Qs on here as well. And let's actually go, let's go long term. So I'm going to go a quarter, but I'm going to go on a weekly chart here on the 13 week. Let's zoom this out to, we'll go full 20 years on a weekly chart. And that's where we are right now. The diamonds along with the Qs, you know, we're below 50%. You can see it's generally above. I mean, it was negative here briefly when the NASDAQ was taking off and the Dow was falling. And then they both started to rise a little bit until here just recently you can see the correlation starting to come back down. So dramatic change. That's you can see it's not common for it to be negative at all. And of course the Russell 2000 is very you know, had a minus 50% negative correlation. And you can see, look at the NASDAQ taking off here with the Russell not going much of anywhere. So to the point where the move right now on the ratio chart of the Qs relative to IWM is almost at 2. It did, in fact, it opened up today above 2, stayed above 2 for quite a while before finishing down. But again, above 1.99, I mean, it's really gone extreme. All these oscillators, extreme levels, CCI, DMI, RSI, all extreme levels. And we haven't been above 2 since the tech bubble. So that's a dramatic move on the Qs here, really just in the last few weeks. But really since the credit issues, when you look at, let's go to like a 6-month chart or 3-month chart here. So you can see exactly when this really started to take off. It was back over here on March the 6th. You can see at that point is when it really took off. And from March the 6th going forward, if you were to take a look at like this asset class comparison, we'll come back to this in just a minute. But from March the 6th, so starting on the 6th going forward is when it really started to take off there. The Qs relative to IWM, the Qs are up 17% from that period. I mean, that's just a month and a half. And IWM is down 8%. So 25% difference, percentage point difference between those two. It's dramatic. SPY is obviously in the middle. And then you have commodities and real estate down here. Other risk on asset classes down with IWM. You have gold up with the Qs. So, you know, you have in bonds too, you actually have risk off asset classes performing well with the Qs from that period. So you see the big change and big difference there in the Qs, and you can see it lining up in a lot of these charts. The S&P is well above its 8-day moving average, above the point of control, above the value area. So really trying to get going. A lot of that's with the Qs. I mean, look how, I mean, the Qs are way, way, way up. I mean, if you look at like how far above like the 17-day moving average the Qs are right now, it's way up. It's not the most. That was February 2nd again, that exhaustion gap that we had. But if you follow my cursor over, it's not, you know, this is a very high level. It was a high level over here. It didn't spark the, I mean, you had a much bigger histogram there. It was a high level here that we continued higher in August before the Jackson Hole smackdown. And then, like I said, the exhaustion gap that again had a much higher histogram than what we're seeing right now, especially with the stochastics below its moving average too. And again, making the move just to get to that 23% retracement level that the Dow and the S&P have already been trading by. Your diamonds, on the other hand, are trading still below its 17-day. The MACD is below zero, slightly above its moving average, but below zero there. And then IWM, you can see sitting on its 200-day moving average. IWM is below its 200-day moving average and trying to get back below MACD. Here, let's get to the regular MACD here. But you can kind of see too. So there's the diamonds. MACD is actually below its moving average slightly. Here's IWM. It's above it, but the stochastics is down. Oh, you just barely got the crossover on the MACD, and you're still slightly above the 17-day and slightly above the point of control too, but obviously not nearly as bullish as what you're seeing in the large cap indexes. Looking at the DMI, you see just how parabolic the Qs are. The S&P above 30 is a big number, but not 47. I mean, that's a tremendous number on the Qs compared to the diamonds, which are showing a bearish pattern, right? And IWM, which is flat, both of them kind of at 25. The ADX is below 10 on IWM. The ADX is setting up for some kind of breakout move right now on the small cap index. I think we all hope it would be to the upside, but considering it's so sideways at the low end of its range, you would expect it to be to the downside, which could ultimately bring the rest of the broader market down along with it. Looking at the RSI and the CCI, of course your NASDAQ is just tremendous. The RSI is at the highest level of this cycle, even higher than the February 2nd peak, way higher than the mid-August peak. Got a big time divergence setting up after peaking above 200 on this first peak. You got a big time divergence setting up there. Of course, your Dow Jones Industrial Average in bearish territory. Both of these in bearish territory. Your Russell 2000 kind of at neutral levels still, right smack dab in the middle. Let's look at the Ichimoku cloud. We'll take a look at the Qs. Still showing their strong trend, very strong trend, almost above 5 now on that. So, very high rate of change, very strong trend. Your diamonds, on the other hand, are, have no trend. Whatever bullish trend we had is gone. We're flirting with the bottom end of this, of the cloud, and the same thing with IWM, flirting with the bottom end of the cloud. Again, haven't had a trend going for a while and have a negative rate of change as we speak there too. Finally, let's look at the Bollinger Bands. Looking at the Qs, remember we were above the upper band. We were up to 98th percentile of the upper band today, still way above the Keltner channels. So we are extremely high above the Keltner channels on the Qs. Remember the diamonds were flirting with the bands kind of, they've been coming back in, and the diamonds were flirting with the lowest quartile. We are back up out of the lowest quartile, but barely. So that's kind of where the diamonds are. Your IWM is smack dab in the middle, with the bands also smack dab in the middle. So your IWM is just kind of like coiling all this potential energy waiting to activate. And considering where QQQ is right now, and how high it is and how extreme it is and how parabolic it's gone, you wouldn't expect the IWM to break out too. In fact, any breakout on IWM to the downside probably would be followed by, a parabolic correction on the Qs. Not necessarily a tanking, but also not necessarily sideways or grinding either. It would be pretty darn significant considering how far up we've moved. I mean, you look at the volume profile right now for QQQ, and you are so far up above the value area that there's not a whole lot of volume support back down towards these moving averages down here. If you look at today's intraday move, you'll see that we did get a new high today on the, so your rune indicator is still very strong, and you're almost at zero on the negative indicator, even though with this big kind of spike or breakout to the upside, you don't really have very big of a channel change. You're still extremely low on the price, the channel width. Not so much on the Qs. The Qs did ramp up pretty sharply on its bullish breakout. Of course, your diamonds have had a bearish breakout, and as of right now, you're not getting a new. Your new high is going to drop down. It's still going to be right around zero over the next couple of days, and you're flirting with new lows IWM has really come down. I mean, you look at its channel width, it's really low. You had the bullish breakout. Obviously, you're about to hit 0 and break below 70 at the same time. So you're going to be set up for a new low point. See, then by the end of the week, the new low point is going to be right there, and that's how tight the range will be and how close you'd be to getting. I mean, right now you're in the upper half of the range. The diamonds are the only ones that aren't, but you're not that solidly in the upper half, to say the least. Looking at today's, again, coming out of the holiday with big news, you look at today's range was below average and the volume was below average. So, I mean, that's kind of a little surprising considering it was looking so bullish over the weekend when that news was leaked out there. Those numbers are really small, and when you look at the VIX and what it did, remember it generally jumps up on Mondays, was actually kind of up slightly, but not very much, and still is kind of below this 90% mark, and you can see what it's doing with the VVIX down there. The VVIX dropping further below 100, so losing some of that. Looks like maybe a lot of this elevation was due to the debt ceiling, and if we can drop back down into the 80s or low 80s, because that's where the VIX is right now, then that would pretty much help solidify the bullish trend going forward and allow some of these other cyclical areas to catch up to where the Dow Jones is. I think that's the unlikely scenario. I still am expecting volatility to jump up a lot higher than this. But we can get the volatility to stay down if the VVIX can come all the way back down to the low 80s too and stay there and not just dip and bounce very quickly. All right, now let's take a look at what's driving this price action. You can see the Q is up 19% still over the past 3 months. Gold is up. We talked about these other three and where they're at there. Let's take a look now just how things performed here today. So let's go May 30th, and we'll go to that 5 minutes. Again, you can see the Qs were up the most at the open, of course. The S&P was up, IWM was up quite a bit. They didn't finish up, right? The international stocks started the day down. They finished down despite a weakness in the dollar. They finished down 1% or more. Commodities getting hammered today, down 2%. That's not something you expect in a risk-on day. It's not something you expect with the dollar down. But yet, you can see gold rallied with the weakness in the dollar, and bonds rallied too with yields coming down. But not your typical risk-on move there. High yield did underperform TLT, and you can see IWM was down 1/3%. So quasi risk-off day. Again, we've looked at this on the weekend market outlook. When you look at the major, the 12 grid here for the major economies that are out there, the biggest economies that are out there, you can see, look at China getting down to new 3-month lows, getting below the cluster low that you see there. Canada is flirting with getting below its cluster low. Same with UK. I mean, you got dark pink shading and red line in multiple countries, even though Korea and India are still relatively bullish. India with a pretty significant down day here today, relatively speaking. And you see S&P with the light pink shading and the green line. Brazil with the light pink shading with the yellow line there, even though you're above it, and the moving average is moving slightly lower. So you can see how the weakness there is kind of across the board. Your TLT has been so bearish for the last couple of weeks with this debt ceiling issue. It did rally pretty sharply. The MACD is green. The stochastics is almost green. It's above its moving average. Moving average, really, really low levels. So it looks like your TLT is looks like it's trying to make a move back up to some of these moving averages, at least getting up to the 17-day, as the 10-year yield has pulled back to 3.7% after getting above 3.8% late last week. MACD and stochastics rolling over. The 30-day had crossing above the 50. Usually when you get a cross of the 50 by the 30, you get some kind of return move back down into this area, and we'll see if that ends up being the case this go around. for TNX. And of course, we saw the dollar move being slightly lower, but still easily above its 8-day moving average. So not necessarily breaking down per se. When you look at the dollar versus all these other currencies here, we'll do the comparison chart here, and let's look at just today. So again, May 30th. So there's your dollar. Your dollar is actually up against, or flat against, these commodity currencies, the Kiwi, the Aussie, and the Loonie. There was up against the franc, which is another safety trade, way up against the Mexican peso, and some of these other commodity-related, Swedish krona, the Norwegian krona as well. But it was down against the pound, down against the euro. The dollar was down against the Japanese yen. So that's kind of where the strength is. And the Japanese yen being the most bullish isn't necessarily like risk on either. That tends to be, one of the kind of a safety type trade in the currency world. If you look at the sectors, I've shown you before these sectors. Your 12 grid is just looking very, very bad. You got these three stocks up here, three sectors up here, one with a 21% 3-month return, another with a 16% 3-month return, and then everything else is negative, right? You have 8 sectors that are showing bearish patterns in the market forecast. 7 of them are negative over the last 3 months, the numbers there that you see highlighted. And then you can see how many of them were down today. The only one that was up today was real estate, coming off of a double cluster. In fact, real healthcare did get another cluster, so it's three in a row for healthcare, or 3 out of 4 for healthcare. But 1, 2, 3, 4, 5 sectors, all 4 safe haven sectors, and then along with materials, all getting double clusters last week. And like I said, flirting. The staples actually got below its cluster lows, as did healthcare with a new cluster, and the others flirting with getting below their cluster lows. So, I mean, they're not looking to bounce up right now anytime soon, which, like I said before, if we're going to be weak, these are the areas that are going to probably draw us lower until we finally get so bearish that the XLK and XLC, XLY, they're going to behave as safety trades initially during any period of risk aversion, will follow suit and eventually turn into risk appetite trades as well, and the markets will sell them off. Otherwise, if we're going to be bullish, then expect these to continue to lead higher. These will probably catch up and eventually turn bullish too, but not outpacing the big mega cap names, which continue to gobble up cap weighting, market cap weighting from an individual stock. I mean, you've got like Microsoft, Nvidia, Broadcom, Apple making up 57% of XLK. You have Meta, Google, Netflix making up 57% of XLC, and of course you have Tesla and Amazon making up like 45% of XLY. All 7 of those companies making up, again, over 53% of the Qs and over 7% of the S&P 500. So huge numbers that, again, that's not typical to be so concentrated at the beginning of bullish moves. It tends to be kind of the end of bullish moves when you're that concentrated within a handful of stocks. But you just don't know when that end's going to occur, because you can go into so many extra innings. As we saw in the 90s, you can go into so many extra innings. You just don't know when it's going to occur. What you do know is if you're going to have any kind of weakness in your portfolio, any kind of negative deltas in your portfolio, it's probably best to get them from these sectors, not necessarily the 3 at the top. All right, our trade idea is actually in one of those areas. It's actually ConocoPhillips. It was down today 0.2%. You can see it's actually off of the open, but still finished below the moving average. So you have the red line. You have dark pink shading. The intermediate line turned back down below 50. Bearish short-term sentiment right now. When you look at the long-term crossover, you do have a death cross still. You've been below on both the 10-week and the 40-week moving average for a while, and I've been getting a lot of transition candles, so no clear directional move quite yet. PPO is negative down there and falling slightly. When you look at the 3 green arrow chart, you are, as I mentioned, below the moving average, just barely. The MACD is not red yet, so Cass6 is below its moving average, falling out and a little bit above average volume there. So we are, again, below the point of control, so you got a pretty significant resistance up above us as we are flirting with a little bit of a change in direction to the downside, the negative directional index. And they're both below 25, but the negative indicators crossing slightly above the positive. You're not getting strong signals here either, but you are below 15, below 0, just barely, but you are below those levels. And then you can see we are below the cloud. The cloud's really flat. We're not trending. The rate of change is negative. There's no trend going on, but you are below the green line, below the cloud. So there's some slight bearish, there's just not strong enough bearish signals to actually make a trending move out of this. So you can see you're in the lower half of the bandwidth, not necessarily in the lowest quartile, a very, very narrow bandwidth to say the least. So what it's had to do is do a bearish trade that's not so bearish. So we're going to go over here to its options chain, and we did this in the Market Outlook Live already today before the market closed. Sell, this was in the kind of the high 30s delta. We're going to sell that that 40 delta here, the 105, buy the 110 for protection. Sets us up for our full position size, getting about a $450 reward for that. Our break even, you see, is actually above this high point, and you can see above the break even is that strong volume node. So there's tremendous resistance to the upside, and we don't need it to go down. Here's where we're at right now, and it's up a little bit since we got into it. That's where it's at right now. We don't, and actually there is a pretty wide spread, so that's part of the reason why it's up since we got into it. But it just needs to stay down below this 105. So it can go down some, that's great. And if it can go down before, we're so far out from July expiration, we got about 30 days before we even get to that 20-day window. And as long as we're outside of 20 days, we can still make other July trades. So if I can get a good return, say 50% or more before 20 days expiration, then I can be able to take my gains out of this and be able to put that full $1,000 somewhere else and try to get a new maximum gain somewhere else. So that's the beauty of having so much time, and also the beauty of the flexibility of the trade, where I don't really need it to go down, but if it does, then I can make 1.5 times a maximum gain by moving this trade. So we'll see how things end up behaving here over the course of the next couple of weeks. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video. Join us at marketscholars.com for free. Follow me and like us on Twitter and Facebook as well. Have a great rest of your Tuesday night, everybody, and we'll see you all tomorrow.